Great. Okay. Okay, fantastic. Good afternoon and good evening. I'd like to welcome you all to the Gulf Intelligence Global Energy Outlook Forum. We're in the Americas session now. We just started that about half an hour ago, having visited Asia Pacific, Middle East, and Europe. And for the next 2-3 hours, we'll be hearing from a few of the 50 analysts that we have accumulated today to give us their insights for the year ahead, 2024, on what's happening in the energy markets. I'm delighted to be joined on this panel by Clay Seigle, Director of Oil Service at Rapidan Energy Group, Brian Pieri, founding member of Energy Rogue, Mike McGlone, Senior Macro Strategist at Bloomberg Intelligence, and James McCallum, CEO and Chairman of Xergy Group and Professor of Energy at Strathclyde University. Thanks so much for joining us, gentlemen. And we're going to be discussing for the next half an hour what impact the US oil majors sort of M&A activity that we saw in 2023, in the cusp of 2023, the final quarter, what impact is that, or could that have on capital expenditure towards boosting output levels in the US even more? We just had a session an hour ago where one of our speakers was adamant that the reason, the surprise of the year last year actually was US production, amongst all the other sort of gray or black swans that we may have encountered, that really was a surprise to everybody. So let's talk a bit about that and see also what lies ahead. Clay, let me welcome you again and start with you first. First of all, was this a surprise to you, or did you see it coming? And, do you expect the same as we move into the new year?
Hi, Diala. Thank you for inviting me and Rapidan to participate today. And Happy New Year. That's right. Our outlook is that the new year, 2024, is going to bring continued growth in U.S. supply, but it's not going to be as robust as we saw last year. And I think for many observers, the timing, if not the volumetric increase from non-OPEC sources like the United States, was a bit of a surprise. Some projects in places like U.S. Gulf of Mexico, but also Brazil and others in the non-OPEC category, came on faster than the market was expecting. So good news for balancing the market from a consumer standpoint to have more supply, but obviously tricky for OPEC Plus to manage markets and expectations when supply comes on faster. The situation for the new year is, like I said, U.S. is going to continue to grow, but at a slower pace. So maybe like low to mid single-digit percentage, actually, for the next several years. So it won't be as robust as what we saw in 23. Sorry.
Okay, thanks, Clay. James, let me go to you on that. We've got the EIA forecasting. We are going to have sort of robust production this year, next year. As Clay said, perhaps not this jump that we saw in 2023, but on the technical side, let's say, is this something that the US, that's what this US majors can do, the super majors now, the M&A, the stronger cash flows that they may have? Will that make the difference to maintaining these levels that we've seen, do you think, or not?
Well, look, I mean, I think for me, the surprise was that the increase in production in the United States didn't primarily come from increased drilling activity, which would have traditionally been what you would have expected to see. And we often chat, as you know, Dial, about all of the rig activity that was the direct rig activity was going into recompletions on wells which were producing as much. I think the great success story there has been a technology one, twofold. Obviously, increasing production from existing wells, deferring depletion in the fields where those wells existed. And the second is obviously in following a much more efficient process in terms of bringing that production on stream. So, whilst there was an awful lot of discussion last year around, quite rightly, the energy transition, clearly the digital transformation of the industry is also well underway as the energy producers are becoming more efficient in terms of the methodologies used to bring that production on stream and using their capital much more efficiently, which of course is taking a very big box for Wall Street.
Okay, well, you mentioned Wall Street. Brian, welcome, and let me go to you on that. Of course, in the shale patch, we've seen before last year, we'd seen a sort of plateau, a slowdown, plateauing, etc., as shareholder sort of priorities were kept by the players there, and as sort of demand dropped, I suppose, as well. So they were sort of juggling those buckets. But again, the same question to you going forward for this year, from what you're hearing. Are we going to see continuous incremental increases in US production now that we've made this jump last year? And how fast do you see that happening, and where will it plateau once again?
Okay, let me say a couple of quick things, which is one basic building block is building production off the back of rigs, and from the COVID trough to the peak of rigs in the US last year, we grew rigs by 300%. And during that same period, we grew production by 20%. So the fact of the matter is it takes a lot of economic momentum, and that economic momentum is shifted to where the rigs are starting to come back off. Now, to James's point, there are a lot of recompletions and a lot of things that are going to keep it up, but the basic engine of new drilling is starting to slow down. So I actually take a contrarian view that we've seen the peak. And another point that I'd like to make is from 12 million barrels a day to 13.2 is where we exited 2023. About 300,000 barrels a day is a change in how EIA reports their numbers. There's transfers of crude that is used as blending stock, and that's been added into the number, and they used to handle it differently. So I actually see that the actual production is beneath the headline, and that we're actually about to start a decline, and I'll be bold and say we're probably going to struggle to stay above 12 unless we see a response on rigs this year.
Okay, thanks, Brian. So, Mike, I mean, on that point, and looking at sort of the price, let's say, of oil, does it make a difference? I mean, shale is economic, obviously at today's prices, but how, what difference would it make if we saw prices drop this year, oil prices, and would that impact things, or does it make or are we going to see that sort of plateauing anyway? Where are you on that in terms of the cost of production, and what would spur more or less production there?
Well, I'm still bearish crude oil prices. I think the pendulum is going to continue to swing lower on the back of that big pump to the peak in 2022. But I think the key thing, and it's what you've already discussed with Clay, James, and Brian already, is this surprise in production. For some of us, wasn't a surprise, but it's on the back of the normal invisible hand that Adam Smith taught us about, and an elasticity in supply and demand. And Brian and James point out, it's just easier than ever and more efficient than ever for people to produce commodities with less. And we use less. Now, yes, there's some emerging markets that are still using, but the macro for commodities is very poor. And this is where I like to point out, was to use crude oil in an isolation away from other commodities is what a lot of people missed last year. And Brian and I talked about this earlier. We've already got the example from U.S. natural gas. We talked about it right before we went online. Natural gas has done what I think crude oil will do. It got too expensive. It made it a lower high, and now it's stuck between 2 and 4 in the U.S. for who knows how long. Crude oil is doing that. So I think crude oil is going to head towards 40. And it's also similar macro, because I think copper's heading towards 3. Right now, it's a little bit closer to 4. And I think corn's heading towards 4. Now, those are the 3 seeds of commodities. And I like to point out the only one that's really going up is gold, and for good reason. Now, we can get into that later, but this is why I like to rope in the macro of crude oil. Of all the commodities, it is not only the most significant, but is also the most autocorrelated. And then you look at all the major shifts that happen. This is one key thing that really kept me bearish, is reading the book. The Domino Effect by Eric Brazil, and I can mention 3 or 4 other books that point out these cycles I'm talking about. And now we're into a very bearish cycle right now. We haven't even started central bank easing, starting with the Fed. And typically it takes a long and variable lag from the start of an easing cycle for commodities to bottom, PPI is the bottom, which is negative in this country, which is negative in China, and for isms to bottom, which are just tilting, breaking below 50 in this country and on a global basis are almost there. So the cycle is very bad for commodities. We got too expensive to 2022. We brought on all this supply. We squashed demand, not so much, but we curtailed it. And now it's all swinging downward. And the key question I like to ask for this year is what stops this downward trajectory in all commodities? I mentioned the C's, copper, crude, and corn. And the key thing what it usually takes is some kind of significant surprise demand out of China, which is tilting negative. All the things I read in our Bloomberg economics point about China is it's just similar to what happened in Japan. It's just reverting a little bit. And so that's why I see WTI this year might hit $40 a barrel. I think it's very unlikely to get above 90. And I think that's going to be part of that reset that's normal. And most of us have lived through this. We have to see that reset. You got to get prices squashed before you can squash that excess of supply. So there's one key metric I'll end with that I've been really watching a lot this year, or last year. I started watching it more, and that's the excess of liquid fuel supply versus demand in the U.S. and Canada. And I say liquid fuel because it's not just WTI. I come from a farm background, and we in this country get almost 15% of our unleaded gas from ethanol. By the way, that demand's declining. But if you take that metric and you add an OPEC spare capacity, which is trying to be offset that excess supply from the U.S., it's almost 12% of global production. 2008, when WTI peaked, it's around it was around an 8% deficit. So to me, that's the bent, the tilt. And question I ask myself at this stage is, by the end of this year, what stops this trajectory towards lower prices in commodities? I don't see it at the moment.
Well, I mean, let's thanks, Mike. Clay, let me go to you with that. I mean, OPEC, I mean, Mike mentioned OPEC and you mentioned them earlier. Just in the context of US production, what stops the trajectory, OPEC's been trying to stop further down trajectory, at least in the second half, latter part of last year, as the picture weakened. The US may have sort of thrown a spanner in that works. But I mean, Clay, what about that in terms of forward-looking OPEC plus policy, do you think, in the context of this US production, even if we stay where we are, market share is coming back into it, isn't it? We're coming back to the sort of market share, possibly market share concerns for OPEC plus. The US clearly has a case, an interest to keep prices down. It's an election year, etc. So do you think that evolving dynamics between the US and OPEC plus will change this year? What's your expectation there?
Well, I mean, bottom line up front, we think that we have a very different price outlook at Rapidan than Mike has illustrated. We do believe that we'll average Brent around $75 this year. So we've placed our stakes in the ground, and let's see how we do. But I think one of the reasons we're more constructive is we think that OPEC plus will hold together and will be eventually effective in balancing the market with these supply and demand concerns. And so we believe that they're going to have to, for example, extend once again the supply cut regimen beyond the announced first quarter duration all the way through the first half of this year. And that's what we model in our base case scenario to get the kind of price outcome that I described. If we're wrong about that, and if they don't extend those supply cuts that were announced recently, then of course we would have a much weaker fundamental condition, and we would have inventories building like crazy in the second quarter. We would have a more bearish outcome than our base case outlook. With regard to overall dynamics, though, it's clear that sentiment has shifted against OPEC plus and confidence in the group. We see in terms of managed money participants building big net short positions in crude oil futures and options, and sending the signal that more needs to be done on the physical side. One of the things that we're watching for most of all, though, in terms of the base case price outlook, is the level of influence by the geopolitical risk on the concern for supply disruptions. I mean, in our opinion, the market is mispricing significantly the risk that we will see supply disruptions coming from the conflict in the Middle East. It's been a complete nothing burger. The market has blown it off 100% ever since, I guess, that speech by Hassan Nasrallah from Hezbollah back in November, when he basically said, hey, we stand with the Palestinians in Gaza, but we're basically on the sidelines, and you guys do your thing. So there's been limited border clashes between Israel and Hezbollah in southern Lebanon. Everyone's been reading about it. But in our opinion, between that risk of a bigger conflagration between Israel and Hezbollah, and also what's unmistakably escalating in terms of the Red Sea and risk to oil shipping there, and driving up costs, et cetera, we think that there is a material chance that Iran could become directly involved in the fighting in the Middle East. And for us, we think about the potential for a disruption in oil exports from the Arabian Gulf via that narrow choke point at the Strait of Hormuz. For us, in our modeling, that's a $40, oil price spike. It's not our base case. We think it's only about 30% probable, but 30% is far from zero. And again, I mean, you don't have to be a computer scientist or a mathematician. A 30% risk rating on a $40 event should still be like $10, $12 into the price of crude, accurately discounting that risk of supply disruption. So we think that maybe the next move for crude oil is probably going to be a little bit higher as the market reprices the risk of disruptions from that event.
Okay, thanks, Clay. So, Brian, just to go to you with that, I mean, do you agree that the risk premium, obviously, it's been discounted in the last few months? We have seen more activity around the Red Sea, as you said, and sort of no real physical disruptions yet, but certainly more than a couple of months ago. Brian, on that front, I mean, yes. So, how soon will the market and with players in the market start to sort of add that risk premium, if you like, whether something happens or not? Will we see them do that?
Pardon me, that's a great question because as Clay said, it's kind of been forgotten, the geopolitical risk, because we have two major wars that are going on in areas that are around or impactful on supply. I mean, Russia produces over 10 million barrels a day, and the Strait of Hormuz, as Clay mentioned, I mean, that is a $40. I don't know if it's $40, but it's massive. If something happens in that area, it is a massive impact. So I agree with Clay. It is not in the current price. A lot of the macro grinding down on price, in my opinion. Mike's making me think a little bit differently. So I appreciate Mike's thoughts because I hold a different camp than Mike, but he's definitely given me thoughts to think about. But I see that it is going to come down to supply and demand. And right now, we from 2022 to 23, using OPEC's numbers, we grew by 2 million barrels a day of demand growth. And now part of this is building back and catching up from the COVID backlog. But OPEC's production's pricing in a U.S. recession includes an additional 2 million barrels a day of growth in 2024. Now, you could argue whether or not that's true or false, but I see declining supply in the U.S. I see geopolitical risk that is not factored into the price there. And in addition to that, some problems that Russia may have continuing to keep up their production flow. If I look at that trifecta, and then add in the additional problems that could happen around the Strait of Hormuz or whatever, I think we're drastically underpriced. So that's my personal opinion.
Okay, yeah, I suppose anything. I mean, if we do get that escalation, that would be a big change. Russian oil flows, perhaps others would disagree because we've seen Russian oil continue to flow. It's still getting to market in different ways, but my sense is the market has discounted that completely now, and that the expectation is things will continue as they are. James, just back to you in terms of sort of U.S. production, and it's a U.S. election year, and of course, and we have a session on this later on actually about Biden's sort of statement when he came into office just under 4 years ago, pledging to not renew licenses, etc., for the oil and gas industry, and the IRA bill we saw start to be passed last year. How does this tally? And we'll be asking other panelists later on the other session about this, but how do we reconcile the sort of biggest climate change investment that's coming out of the IRA bill that's happening very, very concretely in America with the fact that Biden administration has been encouraging more oil and gas production since the Ukraine war. I mean, do you see that still sort of running hand in hand?
Yeah, I think there's multiple parts to that, Diala. I think the Biden administration, certainly from my perspective, looking from the outside in, I'm sure Mike will have an internal view and perspective on this, has been to try to increase production, but not in the US. Now, whilst what we've just been talking about is that we saw an increase in production over the course of the last year, which is indeed undoubtedly slowing. As I said earlier on, that increase in production has not been coming from, huge change in, if you like, drilling activity or more importantly, capital expenditure. It's been coming from improvements in production efficiency, improvements in terms of cost efficiency in the process. And in actual fact, I think the merger activity that we've seen over the course of from 2023 through 2024, and whilst there was some pretty eye-watering mergers done with Exxon and Chevron last year, the actual activity is pretty much on a par with the previous year in terms of last quarter. In actual fact, it's down on the second quarter of 2023. So the merger activity that's coming through there is part of a process of capital efficiency, responding to Wall Street, responding to the lack of debt finance available to the industry going forward. So for me, I think the reality is, as we look out there, is that it's hard for me to, much as I like the comments that Mike makes, it's hard for me to see a huge softening in oil price, because if production is going to stagnate in the United States, and indeed OPEC Plus is going to continue to try to use cutbacks to constrain production, that's not an environment that I think prices fall back from. So, I think a little bit like the comments that we just heard there a second ago from Brian, I think it's hard to see that price collapsing to the level that Mike is talking about. But as Clay said, the stakes are in the ground now. Let's see what actually happens. If I can just draw one point there as well in terms of service company activity, if you look at the fall off in share prices of the likes of Schlumberger, Halliburton, Baker Hughes through the last quarter, and indeed year on year, what you see there, and let's remember, it's the service companies that actually make things happen at the well site. There is clearly not confidence that we're going to see any ramp up in major activity and capital expenditure anytime soon. So I would just like to make that point too.
Okay, thanks, James. There's our survey question for our viewers. Will the US oil Mega-Shale measures in 23 lead to a greater capital expenditure and higher output levels in 24? What I'm hearing is not really. They may help to sort of maintain where we've got, but they're not necessarily going to, for different technical reasons as well, lead to the same sort of jump, I suppose. Mike, just sticking with the merger sort of story, there's more of them to come, aren't there? There's a few. We saw the two biggies, $100 billion in total, the Exxon deal and Chevron. But is that activity, we're going to see more consolidation in the sector, do you think, going forward? And what difference will that make?
So that is a question, Dala, for my colleagues. I want to just give a little bit of, I guess, somewhat pushback, a little counter view in some of what was just discussed. And because we need to, let's have some discourse here, and it's how we learn and educate each other. So first of all, let's look back at the history of oil producers going at it in wars. Iran, Iraq. I remember that bottom came around 10 in 1986. That's when I was in the trading pits, and that was a great way. When you go at it and you need to buy armaments and you can produce oil, you will, and you do. That's what's happening. It has been happening. Let's look at the last significant invasion comparable to when Vladimir Putin invaded Ukraine. And I didn't say Russia, it's one person, is when Saddam Hussein invaded Kuwait. Oil popped from 20 to 40. I was in the trading pits then. That high lasted till, what was it? It was 1990. It was about 14 years, and the bottom came around 10 again, 1986. We're doing the same thing now. So the potential for geopolitical risks now are great, but we just had the biggest event in most people's lifetimes with Russia, with Putin's invasion of Ukraine in 2022. And we're in the back end of that now. So expecting more of that? Yes, it's trickling down. But let's just think about if, say, things do flare up and there's a major supply shock from the Middle East. What does that do? If it pumps oil to 90, it crushes China and Europe, and it helps the U.S. I mean, the U.S. is a net exporter. And what it does, it tilts the world to a recession, and that 90 price will end up being 40 within a few years. It's just a matter of time if that happens. So maybe it's a short-term trade. I used to structure options positions for that, but you have to be careful. And what happened was oil did pop to 95 the week before the invasion. There was a little bit of something going on there. Where are we now? 72. I'm talking about WTI. So I look at it as the key question you have to ask yourself is you have to hope the U.S. doesn't enter a recession. Now, Bloomberg Economics says it's happening this year. Yes, we've been wrong. Yes, we've been early, but it's all kicking over that way. I just published today on PPIs and ISMs are all heading negative, and it's that cycle with interest rates. Then I look at crude oil. It usually does its part to help out. Just since the peak in 2008, the low's been below 40 and lower every time. The high's been lower and the lows are lower. There's a trend, and what stops it? You need global economic expansion, and every time I speak to our economics team, the revisions for global economic growth are downward. So what the actual oil producers, I still think what you describe in this space is why you always need some exposure to oil producing is for and equities is for that risk of events like what happened when Mr. Putin invaded Ukraine. But right now, the thing is you have to hope and expect these unexpected supply shocks. Yet if you look at the typical cycle in commodities, every time you get a massive shock like we did in 2022, it takes years for those things to work out. And now the technology is more advanced than ever. And I just like to point out the biggest demand pull sources of crude oil the last few years, the U.S. has shifted. Now we're a net exporter. You look at Japan. Japan used to import almost 4 million barrels a day. Now it's 2. Where's the shift? It has to come from emerging markets, and they're shifting to EVs really fast.
Okay, well, let's talk a bit about net exports. I want just to go to Clay on that. U.S. oil exports are increasing, and LNG. For that matter, and that gap of the U.S. exports and Saudi or OPEC plus exports is narrowing. OPEC plus market share going down, U.S. up. Clay, do you see that? I mean, obviously, continuing one way or another. We talked about market share at the top of the hour at the beginning, but is that a concern? Do you think for OPEC plus in terms of the U.S.'s focus is on exports, isn't it? It doesn't, in terms of its refineries, they don't need that kind of U.S. oil. They export most of it. How much of a concern is that, do you think?
Well, I mean, it's always a concern among producers to think about market share, but maybe there's a bit too much hype in the public sphere thinking about some impending collapse of group unity and how that would affect prices in the new year and beyond. So to be sure, the United States is now a major supplier of crude oil to the world, just as it had been for a long time for refined products. I mean, 4 million barrels a day plus of crude puts the U.S. Stands along with the biggest exporters within the coalition. So they're always keeping an eye on it, but it would have to be a really acute situation to have the core contributors in OPEC plus to take a different strategy than they have already, which is managing the market. So we're not expecting them to approach this challenge by kind of turning a new chapter, throwing in the towel on supply discipline, and trying to surge supply in order to have a race to the bottom for prices and basically undertake a market share war against shale. We're not expecting that to take place in this episode. But what's important to note, though, is the level of basically cohesion within the group. I think everyone noticed that Angola dropped out of the OPEC group recently, but we don't expect things like that. It's marginal in terms of effect on OPEC plus crude supply and total liquid supply in the world. So the main thing to focus on there is the signals that are being sent by core members of OPEC plus to adhere to the established agreements and to deliver on target. And we generally have confidence that they'll be able to weather this part of the down cycle in terms of prices and keep that unity going. So far, the market is not completely buying that optimism, but we think that's liable to pick up if our expectation proves accurate, extend their supply cuts, and the market can see reduced supply in the marketplace during the first and second quarters of this year, we think balances will tighten. And to speak to the macro front and the effect that that has on crude prices, we definitely agree that oil demand growth is slowing in the new year compared to what we had last year in China and in other important markets, but it's hardly contracting. And so if we had 2.2 million barrels a day of growth supporting oil prices above 80 last year, we still see like 1.6, 1.5 million barrels a day of growth. It's the velocity is maybe half of what it was last year, but it's still constructive for oil prices generally. That's how we're approaching the new year.
Okay, thanks, Clay. There's our response to the question, will these lead to bigger output levels? No, 56%. It sounds like our audience is sort of agreeing with us. James, just a quick question before we wrap up on sort of sentiment, economic global growth sentiment. Mike said that, Bloomberg is still expecting a US recession. We haven't seen that happen. We saw the US weather many storms, I suppose, in terms of interest rate policy, et cetera, that might trickle through. But again, the sentiment you're getting both for sort of US, China economy, more of the same into 2024, and will that sort of hold us where we are with prices, all else remaining equal?
Yeah, look, I think it is. I mean, in the short term, I think we will see more of the same. I mean, obviously, black swan events aside. I mean, in the questionnaire, I think 56-44 probably split right down the middle. I was a no vote there. I do think we will continue to see improvements in efficiency, but I do not think we will see a wholesale switch away from the capital efficiency that the majors have been exercising for the last 18 months into putting spending into wells. And I don't think the markets would respond well to that in the course of the next year. We're all still sitting waiting to see what will actually happen there. So for me, we've obviously got to watch what will happen, as I say, in terms of geopolitics over the course of the next quarter. But I think, we'll see steady as it goes. Biden will still want to try to see prices on the lower side for the election. I think there will be a trade-off between what happens with Fed interest rates. There was a really good session earlier on that was there where Arnie was talking about seeing sort of reductions in interest rates starting by the Fed in June, giving 3 opportunities for reduction by the time the election comes in. And if that triggers a recessionary environment, perhaps an even greater drop in interest rates to try to turn it around. So clearly there is a real playoff inflation, as Mike talks about, against maintaining and stimulating the US economy with interest rate cuts. And we're going to have to see how those two things play off against each other.
Okay, thanks, James. Brian, I see you nodding there. What's your sentiment sitting in the US on where the economy is going this year? We're still seeing pretty healthy numbers all round. Would you say, though, that those interest rates will start to trickle through and we'll go back to square one, start to see them being at least cut, maybe more than people expect?
Yeah, and there's a historical good correlation between interest rate hikes and interest rate drops and crude oil price. So because it does impact the economy throughout the infrastructure. So if we do ease rates, which I would expect alongside James, if we do ease rates, I think that helps support the crude oil price from a economic perspective or currency perspective. And then there's another factor in addition to that, which is how to handle the debt issue in the United States. And a lot of that is inflating it out. And inflating it out adds more economic support to the price when you're looking at a dollar basis. So I think that there's a lot of economic momentum that adds support there. But one thing, you asked a question about the recession. I mean, honestly, I'm tired of hearing about it over 16 months. And well, where is it? When is it going to be? As a matter of fact, I think one of the Gulf intelligence, there's a gentleman, Omar, who keeps saying, nah, it's not going to show up. It's not going to show up. People are going to be surprised and we're going to rip. Now, he may be a contrarian, But I like listening to opinions that don't align with myself. And as much as I said earlier, I hold a very bullish bias to the crude oil price, which is different than Mike. But Mike's points are phenomenal and are really going to make me study a little bit to make sure I sharpen my pencil on my view. But I would say we haven't seen it yet. There are some indicators. There are some forward-leading indicators that say it is coming. It may be later this year. It may be in 2025. That it is a slow-moving train wreck. And I don't know where to put those indicators because a lot of people say that the economic growth of 2023 was around catching up from the COVID backlog. So hopefully that answers your question.
Okay, thanks, Brian. Clay, I'll give you just the final word. I wanted to go to you with a similar question that I asked James earlier, which is on this, and again, we'll be talking about this in a different panel later, but I'd love to get your view on it. In terms of the balance of the US policy of, encouraging more production to keep prices in check, particularly in election year, and encouraging obviously renewables investment, clean energy, the CHIPS Act, all that, for geopolitical reasons, if nothing else, securing sort of onshoring supply chain. Where do you think that the policy will go this year, if you like, in terms of encouraging those two tracks?
Yeah, another great question, Diala. Thank you. I was filling my car with gasoline the other day and looking at the pump price and thinking, this is a dream come true for the Biden administration and the folks that have been so worried, especially throughout 2023, up until the end, up until the fourth quarter, about the potential for another energy and oil fuel price spike leading up into this very sensitive election cycle that we have in 2024. And this is part of the feedback loops in our industry that are going to have such an important effect on those geopolitical and world policy concerns for the new year and beyond. And so another Trump administration would look very different for the energy landscape and for global affairs than another Biden administration. And at Rapidan, we're spending a lot of time advising our clients on what those two worlds could look like. But the thing to remember is that right now it's kind of a calm before the storm, and especially correlating with those fuel prices in the United States, which is still the world's biggest market. And so on the demand side, so watch those pump prices, and I think also diesel prices as we get into summer. Another great reason or driver to think about the supply surprise, if you want to call it that, for last year in terms of United States supply was we didn't have any hurricanes at all that affected the oil patch and oil supply during the summer and hurricane season of 2023. That's kind of rare. I mean, we lost our house in Hurricane Harvey in 2017. We're in a great place now, but my point is that's kind of rare. And the summer between the run-up to the election and the conventions that'll be garnering so much attention in the United States, not just on economic and energy policy, but across the board with these complex problems that the United States has to help lead the world going into the next 4 years. That kind of confluence of risks could change the price environment very quickly. And even though this isn't part of our base case, if we do have another spike in either gasoline prices and or diesel prices proximal to the election, even if it's kind of way before, like in summertime, it's possible you could see renewed interest by the administration, by others in Washington, in policy interventions in the oil market that could influence the price path. So we're helping navigate those challenges for our audiences and keeping a close eye on the election lens for oil prices in the new year.
Okay, thanks, Clay. You made a point that the Biden and Trump administration would be very different, obviously geopolitically, but maybe on the, Make America Great Again, not so much. I mean, the IRA Act is very much probably something that both presidents, dare I say it, would continue to push. Gentlemen, thank you for joining us so much for this. This brings this session to a close. I'm going to ask you to stay with us because we're going to continue this hour with an interview that I did with Vitol, the head of carbon at Vitol, Michael Curran. Not related, slightly related to this topic. We were talking about voluntary carbon markets, and of course that plugs into the whole transition and of course, and how they may impact, conventional production as well. So I'd like to ask you to stay with us. Turn your cameras off, though, and stay with us till the end of the hour. I'm going to ask my colleague to play the interview that I did earlier this week with Michael Curran. I started by asking him, again, the topic was voluntary carbon markets, but I started by asking him, whether things like this in the US, increased US production, and increased production anywhere for that matter, impacts the parallel conversation of how well we're doing with the transition, and in turn how it impacts progress on progress on things like the voluntary carbon market. So we'll have a listen to that. I'll ask Katrina to play that for us. I'm also going to go off camera as well, and we will have a listen into Michael Curran at Vitol. Thank you, Katrina.
I do think they are linked, and I think that there is a growing awareness. In fact, it came up, and I'm sure we'll be discussing the results of COP28 during this conversation. But one of the kind of latent themes of COP and carbon markets is the fact that methane and methane production, upstream, whether it be upstream, whether it be pipeline, whether it be fugitive gases, etc., is not currently being that well addressed by the carbon markets. It's not very well priced in. If you look at what the role and rationale of carbon markets is to put a price on emissions, and methane obviously being a huge multiplier for CO2 is something that should be addressed. I think there was progress on this in COP. We as Vitol, we see it as part of our role, given that we are an energy player, not just a carbon project player, that we have to address all forms of carbon emissions, which include methane. So we are working on a number of upstream emission projects, and we think that this ultimately, even though for the voluntary sector it's not very popular. So for example, if you're a big retail buyer of carbon credits, you don't necessarily want to put on the front of your ESG report a huge stack and say, we did a great job reducing, avoiding, eliminating flaring from this. You would much rather have a forest, or you'd much rather have something with flora and fauna, etc. However, I think the role of the carbon markets is that we include, going forward more and more, projects and ways of monetizing, or in fact putting a price on those methane emissions. So I'm thinking, or I'm hoping, that in 2024 and going forward, this is going to become a much more important aspect. And I think COP28 helped towards that. And I think, again, the next COP being in Azerbaijan will also help that as a focus in terms of the fossil fuels. So I think fossil fuels are not going away. We have to relate and accept that transition is exactly that. It's not a cliff edge. It is a form of transition, but you still have to do that in a way that's addressing the emissions that come from fossil fuels.
Absolutely. And I mean, you mentioned COP, and of course we're going to discuss that one, but we saw a lot coming out of COP. One was this pledge to The word fossil fuels did come into the statement for the first time, which was progress. But we did not see a deal on carbon markets done. You had these sort of the EU, Mexico, a few others pushing for something, the US and others kind of saying that too much was being asked to find a sort of a deal where countries can and companies can kind of agree on a centralized sort of UN system of carbon trading. So let's get into the nitty-gritty of why you think we're not being able to reach this sort of global deal, if you like. Is the market too developed? Has it developed too fast for us to now sort of seal a deal between domestic and international participants? Is it too fragmented? What would you say is the main sticking points for us to make progress on that and getting to a deal like we didn't at COP28?
Yeah, I think there's a number of reasons we didn't get to a deal. I think that particularly coming into the last week, the main focus was on getting this fossil fuel wording into the final declaration, which I think was it has been to some extent not poo-pooed, that would be too strong, but I think it hasn't been given as much of a green flag or support or congratulations as it merited. I think people forget that at Glasgow, you had Alok Sharma effectively crying on the stage when they walked away from coal. So we've moved in a period of 2 years from, oh, you can't touch coal, to now all fossil fuels. Now, clearly, you don't go again from a binary position of we're not touching coal to all fossil fuels are now banned. But I think people have to respect that, this is a diplomatic process as much as anything else, and you have to have realpolitik in how you're discussing it. So I think that was a progress. Clearly, coming from a trading perspective, the fact that Article 6, and in particular Article 6.4, didn't find a landing ground in terms of wording, as you say, the European Union, Mexico in particular, balked at that. I think to some extent that was part, again, of the attention given to it and the timing of how it was brought in, or the final wording was brought in. We kind of take it or leave it, time ran out. I think it was part of that machinations. But I also think it was the fact that the Europeans, having been, if you go back in time, Carbon 101, the first iteration, they allowed in 1.6, 1.7 billion tons of international credits. It collapsed the EU ETS market for a 5-year period, effectively, in terms of price, activity and volatility. And I think that they are therefore much more cognizant of the fact that you need to build the platform correctly first in terms of integrity, quality, etc. And I think, to be fair, the Americans were saying, no, we need to get on, don't let perfection be the enemy of the good. Let's get on with it. And I think that's the kind of the tension you got to. Again, to some extent, we always keep saying this every year. Next COP, hopefully, will resolve Article 6 and Article 6.4 in particular. But I think for the purposes of this audience, you can now expect to see the private sector, and I would argue combinations of public-private partnerships, effectively bypassing, or not bypassing, but prepping themselves for what they expect Article 6.4 to eventually look like when it is, which is what we all expect, to be signed. So I think you will see the Swiss move. The Swiss are already moving. I think, for example, Vitol has a joint venture with the Nigerian Sovereign Wealth Fund, NSIA. I think you can expect to see a flowering of these collaborations where countries say to themselves, we cannot wait for the eventual wording. We know basically 99% of what it's going to look like, or 95%. So Pareto principle, let's just get on with let's build it as we think we should for the purposes of what we need for our own NDCs or our own objectives. And then we will refine that as we get to the final wording. So whilst I think it was a disappointment, I think you will still see a lot of activity this year in terms of corresponding adjustments, companies like Vitol and other project developers looking for LOAs in those countries, the whole development of the CORSIA, where you now have the bodies such as Gold Standard, Vera, etc., saying, well, look, we will enable there to be a tag attached to the carbon credit, which says it's correspondingly adjusted. You're going to have the voluntary carbon markets initiative coming out. All of these things will create an ecosystem, I think, which won't be perfect. The lawyers will need to do a lot of clever thinking around how it's worded for what eventually Article 6.4 will say. But I still think you can expect to see a lot of development in a quasi or a parallel Article 6 world during 2024 anyway.
Okay, great. I mean, that 2024, of course, is just 12 months, and we have to look at these things in the immediate and then the 5-year trajectory. I mean, I have a couple of figures here in front of me. Voluntary global carbon market was about $1 billion in 2021. Another figure I have is that the potential size of it by 2030 could be 100 billion. Okay, and as you said, these stepping stones are being taken. But it would be interesting to get your views on, could we make such a leap in just a few years? And, you know, for example, is it confidence in the system? Is the transparency clear enough for participants? You know, again, which would then lead to the liquidity and volume that you need. I mean, it's a catch. You know, it's a yin and yang, isn't it? So, you know, what would be on the top of your list tomorrow if you could say, oh, golden tick, we need to do this, and that will really give it the boost and scale that it requires?
Yeah, I'll come to that in a second, but I think one of the contradictory things of last year is clearly, with all the kind of concerns, scandal maybe is too strong a word, but to some extent scandals around certain projects, volumes, the integrity of the projects, etc. That clearly, you know, we speak to a lot of retail buyers, we supply a lot of retail buyers, and, you know, we still see a lot of retail buyers buying and retiring, but not making such a song and dance, frankly, about what they're claiming against it. One of the contradictory things last year is the acceleration we were expecting in 2023 in terms of buying didn't actually occur. I mean, there was some growth, but it didn't really occur. However, commitments to net zero from corporates went up by 40% year on year from October 2022 to 2023. So I think if you look at the asset managers, you know, $67 trillion of asset under management are currently under net zero targets. The actual size of the pent up, let's call it a dam, the water keeps filling up behind the dam, but that hasn't translated necessarily into purchases of carbon credits because of some of the things coming back to your point around integrity, confidence. Is it worth putting your head above the parapet when you think you're going to do something good and actually you then get slated in the press because it's found out at some later point that it wasn't exactly what it said it should be doing, or it wasn't exactly how it should be done? So I think to resolve that, what you ultimately need, and again, some of the things around the carbon market initiatives, etc., will give a framework, I think, of comfort. But again, potentially contradictory to, you know, the private sector and the trading sector, I think you do need more rules. So if you are a corporate and you're listed NASDAQ, it doesn't really matter where you're listed on the FTSE. It doesn't really matter. You need the regulators to say, look, if you're going to make claims around your offsetting your carbon footprint and you're going to use offsets, removals, avoidance, etc., to achieve those, these are the criteria, just like accounting rules. These are the criteria under which we will allow you to say it. And then that would take the burden off the ESG teams, the treasury teams, the C-suites to say, look, we're kind of navigating in a world of confusion and we're not 100% sure. We're trying to do the right thing. We've made these commitments. We can't go back from the commitments, but how do we achieve the commitments, particularly on scope 3? And I think it would really help if some of the regulatory bodies, whether they be at the nation state level or European-wide level, and or at the level where the corporates are listed, you know, on stock exchanges, or the bondholders, just say, look, if you're going to make these claims, these are the rules under which we will accept those to be made. And then that will give coverage to the corporates to say, look, sorry guys, you might not agree with the tax rules in country A, B, C, but we're just performing as per those rules. It's the same with our carbon commitments. It's the same with our net zero commitments.
Okay, Michael, that's great. And what about taking that point on board? You know that you have a general sort of regulatory rules, and everyone and the corporates have to abide by them, and they kind of get a bit of not a free pass, but you know they're doing what they can within that system. What about the sort of geographic diversity of any sort of new regulations or agreements that come in? You know, you're dealing with very different dynamics, aren't you? You know, a continent like Africa and Europe when it comes to sort of dealing with carbon, transparency, abiding by regulations. I mean, is that do you think an issue that will grow going forward or be resolved as these directives come together?
Again, I think coming back to the Article 6 discussion, I would expect to see a lot more public-private initiatives going forward. So I think one of the criticisms that has come from projects, and it isn't just Africa, but let's take sub-Saharan Africa, is it has looked to the external world or the outside world a bit like carbon colonialism. We come in, we take your asset, we pay you $1, we then go out into the market and we sell it for 10, 15, 5, whatever. But basically, there is nothing going back to the local communities, to the local host country. And I think that this is one of the elements that to some extent has tarnished some of these projects, that it looks like, okay, we've gone in, again, we've given you some moonshine, a few muskets, and a few beads, and can we have the whole of Connecticut, please? This kind of, particular. And again, I'm not naming any particular projects, but I think that's the problem with it. And I think what you now have to build is, and I think these corresponding adjustments and this moving to, again, even in the absence of Article 6 having been resolved, I think this move towards a more robust mechanism by which it's a G2G and or it's a public-private, but ultimately going into NDCs, that will create an infrastructure, an ecosystem, which is much, much more robust, because you cannot be defrauding. It's not just a rotation of credits that nobody really cares about. It's now going against NDCs, or it's going against CORSIA obligations, or it's going against something that you can bet your bottom dollar that people will be coming back and auditing, checking, filing through every single DD report, whether it be journalists, whether it be auditors, whether it be the host nation, either the seller or the buyer of those credits. So I think we can expect, again, that to create something which is more enriching for the supplier nations, which clearly it has to be the case. It's not going to work if it just turns out to be expropriation of an asset. It has to be something that benefits the host country and the local communities within that. But it also has to be beneficial for the country that's purchasing them in terms of what they're getting, and they have to, as politicians, explain to their populations why they've just transferred X billion dollars to countries A, B, C, and what actually is the integrity behind it. So I think this will create a much more robust system, and then people like the Vitols of the world are there effectively to manage this, all the moving parts within that, to make it a smoother system, whether it be through financing, structuring, project registration, risk management, hedging, etc.
Okay, yeah, and all those new tools that will come into play, of course, as mature tools that are present in other markets. Michael, just before we let you go, let's talk a bit about the actual global carbon price, okay, and how it's being set, how it's valued. Do you think it's where it's the per ton price? I mean, and excuse my ignorance if there are different domestic versus international pricing. But for example, when you have something in the US like the IRA Act, which is giving all these incentives and offering emitters, $180 per ton versus what the sort of average global price is, where do you see that going? Can we have different prices working together and yet keeping everyone on equal footing, one way or another?
Yeah, so conceptually for me, I'm very happy with the concept of different prices for different carbon markets. I don't believe that there is one carbon market. I don't think there necessarily should be one carbon market. Like any other commodity, people have different marginal costs of production, people have different marginal costs across a whole number of different aspects. And I think it's fine that there be bifurcation or differentiation in terms of pricing, depending on, if you want specification XYZ, and specification XYZ costs more than specification ABC, just like with any product, like a fuel or anything else, well, then you pay a premium for that. But I think the thing that needs to be there is that regardless of all the other, whether it be SDGs, flora and fauna, whatever else you want to build on top, which creates a premium product, shall we say, or a more premium product, the very base has to be for all buyers and all sellers that you're confident that the ton of carbon, which is linked with all those other elements, is actually a ton of carbon that's either been abated or removed. And I think where the wobble has come in the past year or so is that people have not only started doubting whether the SDGs were really there or whether the benefits were going to the local communities, etc., but really, was the baseline right? I bought 1 million tons, but is it really 800,000, 500,000, 300,000, a million? I think at the very, very minimum, you have to get the accounting of the carbon element correct. Everything else, then the spreads, the base risk, or the base differentiation between product A and product B, fine, that can be for different reasons, and different regulatory bodies and different standards can be built up around that. But the base case has to be, if I'm buying a ton of carbon, it has to be a ton of carbon. It cannot just be a rating agency comes in and says, well, they got 70% of the way there. Well, that's not good enough, because then I've really bought 700 kilos and not 700,000, 700 instead of a ton. And that's just not going to work.
Okay, thanks, Michael. Very quick question, just on compliance versus voluntary carbon markets. Obviously, the compliance carbon markets are much more mature. They've been around for longer. According to Refinitiv, I have a figure here, $260 billion was traded in 2020, of course, versus the voluntary, which is not nearly that much. Do you think those things both should continue to walk hand in hand proportionally, or do you see the voluntary markets obviously catching up and the compliance ones lessening? I mean, well, you talked about public-private partnership, that's what it's all about. But again, as we look to sort of see carbon credit hubs, possibly geographically, do you see that ratio changing?
Yeah, so I think, again, maybe I'm talking my own book, but I do think voluntary carbon markets will expand significantly over the coming years. But I also see effectively a morphing of one into the other. I mean, to some extent, I'm not a massive fan of the word voluntary. By definition, if you go out and make a public statement and say, I'm now committing to X, it's very difficult to roll back from that. So to some extent, you might not be under a regulatory body forcing you to do it, but your stakeholders are probably forcing you to do it. Your shareholders, employees, bondholders, etc., etc. So I think the voluntary element is a bit of a misnomer. However, I do think that as you move towards, and again, this is part of the disappointment of not resolving Article 6 at the last COP, once you move into a world where you really do have to have that accounting system in place where 1 ton here going up means 1 ton here going down, then you have to accept that even if you're a corporate buyer, you're probably going to end up in a world where corresponding adjustments become more and more, even if you're calling it voluntary carbon, become more and more important in your actual purchasing process and development process in terms of the projects and the specification of projects you want. So whether you call that, regulated markets or whether you call that compliance markets, I think there will be a morphing between the two over time.
Michael Curran, Head of Carbon at Vitol, thanks so much for joining us today on the Global Energy Outlook Forum. Thanks so much for taking the time.
Thank you very much.